Welcome to Conversations, Season 2 of the MTA Podcast Series, a weekly audio cast featuring interviews with leading investment strategists, geopolitical experts, and other key thought leaders, brought to you by the Market Technicians Association, and your host, Ed Carlson.
Tuesday, September 28th, 2010. This is Conversations, the official MTA podcast series, Season 2. And in September, to celebrate the new MTA office in London, we are featuring an all-Britain slate of guests. And today's guest is Sandy Jadeja. Sandy Jadeja is the Chief Technical Analyst for City Index, a leading provider for spread betting, CFDs, and foreign exchange. He has been involved with the financial markets for over 23 years. Mr. Jadeja has had his comments featured in such media venues as the Financial Times, the Telegraph, Barron's, the Australian Financial Journal, Dow Jones News, and Reuters. Currently, he is featured weekly as a guest analyst on CNBC's Closing Bell, Squawk Box, and provides an educational program on technical analysis for CNBC Europe. He is also featured on Cantos TV and Asset TV, which is recorded exclusively for global fund managers. Mr. Jadeja is associated with the London Stock Exchange and the Investors Chronicles, alongside other leading financial organizations, as a contributing editor providing weekly commentary on technical analysis. He also writes a widely followed column for City AM and features in China Business Daily, as well as the International Business Times and your Trading Edge magazine. Sandy Jadeja, welcome to the program.
It's my pleasure. Thanks for having me on.
Listen, Sandy, we usually start by with some personal information about our guests, but I think before we even get there, could you give us some background into City Index? I think that's probably a new name for most of our listeners, and terms like spread betting and CFDs, I don't know, it sounds like something you do at the dog track. What is City Index?
Well, City Index is a leading provider. It's a brokerage firm based in London. We have offices in China, in Australia, and also in the USA. And basically, we provide a service for people who are looking to speculate in the financial markets through a variety of products, which is spread betting, CFDs, or foreign exchange. But essentially, spread betting's been around for just over a little over a decade now. And spread betting, although the word betting may put some people off, but there's an issue with the word betting. And here in the UK, anything that is associated with betting is tax-free.
Oh.
So, therefore, you can speculate on the markets and all your winnings are going to be tax-free.
Wow.
And CFDs is just another contract for difference. It's just another way of, again, speculating on the markets. They're very, very similar in products in terms of what they offer.
Any betting is tax-free. I find that amazing. I wonder how that ever got passed.
Well, at the moment, we traditionally in the US, you will trade through options or futures. And what happens is that you will get fairly narrow spreads on that. So, for example, if you're trading say, for example, Dow Jones contract, you'll be getting, say, 10,850 to 10,852. And traditionally, in spread betting, the spreads were considered to be quite wide. Around 7 or 8 years ago, you could get a spread of around 6 to 8 points compared to a futures contract. And what would happen is part of that spread would be the cost factor. So in other words, that's where your cost is being paid for, and hence you're avoiding paying tax. But what's happened is with the liquidity and with the number of people coming on board right now in spread betting has driven the cost of the spread much lower. So you can actually get spreads as low as 1 point. So it's a great way for people in the UK to participate in the markets and obviously get all their winnings tax-free.
And just real quickly, again, CFDs, what does that stand for?
CFDs is contracts for difference. Essentially, it's like a spread bet and it's like a futures contract, but it doesn't have an expiry date. Typically fairly low in terms of margins, fairly low in terms of spreads, but it's not tax-free. And so you could use CFDs, and of course you can use spread betting to hedge your bets as well. Now, the one thing I will point out that in CFDs and, again, in futures and options contracts, what you'll find is that the tick value is typically fixed. So let's say, for example, you're trading crude oil and you want to do a CFD or a futures contract, you might find that each point value is equivalent to $10 or $20 or $50 in some cases. Whereas in spread betting, you as the trader can designate the point value. So I can trade crude oil and say, well, I want to trade at $1 or £1 per point. So it's making these markets accessible to a much wider audience than what was typically considered 10 years ago, a very condensed audience.
Yes, I can imagine what that would do to the market. All right. Hey, that's great. Appreciate that. Let's go ahead and get started with our normal routine here, and that would include your personal history. Sandy, for example, where'd you grow up? Where did you go to school? Where'd you go to university? What'd you major in? And how did you make the transition? What happened that introduced you to technical analysis and your first position in as a technical analyst?
Sure. Well, I grew up, my father was actually trading, he was trading on commodities and currencies and the equities as well. So he almost kind of pushed me from a very young age. My earliest memory about the markets is from about the age of 14 to 15. And I was each week told by my father to have a look at the fundamental reports, and he was pushing me in a way, I guess, to say, right, this is something you need to understand. It's going to benefit you in the long run. I honestly was not interested. I mean, at 15 years old, it's not something that I'm really looking forward to. I went down the route of studying engineering, and at the time, I mean, I'm 44 now, so back in that time, engineering, mechanical and electronic engineering was kind of going through a shift, and the computer scene was just starting to take a mainstream effect. So what happened was, as I was doing the analysis for my father on a weekly basis, eventually we were at a point where we were going to sell our computer system, and the person who came to buy the computer system happened to be a broker. And he saw some of the software that I was using and says, well, actually, look, I'm a trader, and I use technical analysis, and that time I was based on fundamental analysis. Mm-hmm. For me, it was long-winded to go through reports, try and understand companies' earnings, and it was just a task I did not look forward to each week. So this broker, Corrado Giovanelli, his name was, an Italian broker, first introduced me to technical analysis, and it was just a new way for me to look at the markets. And I happened to get into a conversation with a gentleman by the name of Robert Krauss, who was featured in the Traditional Market Wizards book. And Robert sent me across some of the information that he was looking at in terms of trading, looking at from a Fibonacci point of view. Mm. And that was really where I started, because I saw the market, and it was the pivotal point for me. It was a complete change. I thought, hang on a second, there's something here. This makes sense. We're able to forecast markets using a mathematical sequence. And that was it. Really, it just took off for me from there. So ever since then, going back from 23 years ago now, I've used Fibonacci as a mainstream tool, and along the way I've looked at Elliott waves, market timing, and various other factors. And over the years, here in the UK, when spread betting first started, I traditionally used to trade on the futures markets and dabbled a little bit in the options arena as well. But I helped launch education here in the UK in the spread betting industry, and we were pretty much at FinSpreads in those days. We were the first ones to offer education. We were doing roadshows around the UK. And then from that point onwards, I'd spoken and was quite a frequent speaker in the New York Traders Expo and also in Las Vegas. We did one or two in Florida as well. So I've been speaking around the world at various expos as well as being involved in the markets, and that's pretty much my background. But my major was electronic engineering. I very quickly, just didn't go down that route. It just wasn't something that interested me. It was pretty much to have a look at, and I thought, well, actually, it's not something I want to do long term. And so technical analysis, trading was the mainstream. So I've been in that field ever since I can remember.
Interesting. And you were almost born into it. This next question may be a little unfair, but it's come up so many times in our past interviews. I think I'm going to go ahead and throw the ball to you. What we've found in past interviews, we've been doing this for a year now, is that, and this is a broad brush approach to painting technical analysts, but it seems like so many analysts either have backgrounds in engineering or backgrounds in the arts, two fields which are just so different. Have you ever thought about that? Has that occurred to you, and do you have any thoughts on that?
Yeah, I mean, my background is engineering, and a lot of people that do know me feel that I probably should have been in the arts, because my creativity is much more higher than my analytical points of reference. And you're right, I found, we teach class, I've been teaching for a number of years, and I have found that people with certain backgrounds tend to do better than other backgrounds. Talk about lawyers, solicitors tend to not perform as well as somebody who's in the mathematical arena. And I guess it's really down to the way we break things down. I remember when I was a kid, you give me an aeroplane or something, I'd break it apart just to look at how it's been made and how it's put together. And that's exactly what I do with charts. I find that I'm looking at a market and I'm breaking it down, asking questions, but I'm also looking at it from a different angle, and that's where the creativity comes in. I want to look at a chart and say, well, actually, this is what everyone's looking at. What is it that people have missed? Which are the areas that people have overlooked? And I guess anybody who's in an analytical point or an analytical frame of mind is probably going to go down that route. It's difficult to say who's going to be more successful, whether it's going to be someone from an analytical point of view or from a creative point of view. I think both left and right brain is going to be useful when it comes to trading. In the talks that I present around the world, I've always said this, that we as people have been brought up to lose money in the markets. And I know people don't like that phrase, but it's true. I'll explain why.
Yeah.
It's like, you're young and your mother says, Ed, I want you to go down to the local shop and buy the loaf of bread. So you say, well, I'm going to go to the one around the corner. No, Ed, I want you to go to the one that's 3 blocks away. Why? Because it's cheaper. Now, that frame of thinking, it's cheaper, people bring that into the trading field and it doesn't work. And the reason is this, that when a market's falling, it is not cheap, it's weak. When a market's rising, it's gaining strength. It's not expensive, it's gaining strength. So in the traditional field, where we've been taught to buy something that's cheap and not to buy something that's expensive, that doesn't work in trading. If it's falling, it's weak, sell it. If it's rising, it's gaining strength, buy it. And that goes against the grain of human nature thinking. Everybody wants to buy cheap. Everybody doesn't want to touch it when it's expensive. And so people are afraid to buy into something that's rising. Don't. It's showing you strength. Buy into strength. If it's falling, sell it. It's weak. So, that's what my form of thinking is when I'm teaching people. That's what I'm saying to people, is that you have to detach yourself from what you've been bringing up in the outside world to the trading world. It's different. And that's why there's only a select few number of people who are long-term successful here. Mm-hmm. That applies to business, that applies to sports and any other field.
Mm-hmm. The financial markets have really turned the traditional supply-demand relationship on its head, haven't they? It's almost as if like if you walked into a shoe store and the clerk ran up and said, "Hurry, prices have gone up. You must buy now."
Well, that's a good point. And I mean, the supply and demand factor, is it still there? I don't know, because the markets have changed. And again, it's something I say: the markets are not static; they're dynamic. And if the markets are dynamic, that means that they're changing. If they're static, it means they're staying the same. Because the markets are dynamic, because the world is dynamic, we are dynamic, you have to adapt to change. And therefore, maybe 20 years ago, the supply and demand factor worked, which I'm sure it still does in certain markets. Commodities are a true area for me where natural supply and demand will always be there. But the stock market, the foreign exchange market, and certain aspects of the commodities market, it's become very speculative. More and more people have got access to markets which you just wouldn't have had 15 years ago.
Sandy, you say
technology you have.
You say that maybe 20 years ago it was different, more traditional, and yet isn't this behavior we're describing simply human behavior? And does human behavior ever really change? Hasn't it always been the same?
Well, yes and no. I mean, human behavior in some aspects does stay the same. But when I say that the markets were different 20 years ago, it's the thinking 20 years ago. People used to buy for the longer term. And they would look at something and say, well, is there a diminishing supply in this? Is there going to be a higher demand? The real estate market, was there really a high demand in the real estate market? Or, we get used to seeing TV programs. You own your house, you buy another one, you renovate it, you sell it on. and so forth. And that supply and demand factor will break down. So human nature is human nature. It will change over the centuries. It will not change over the decades. It will change over the centuries. And I think, and it's a personal view, that we now have become what I call the microwave generation. That means we want something quick. We want it now. You put a meal in the microwave, it's done in 3 minutes. You go to a burger store and you want it in 30 seconds. Yeah. And so what we've done is we've as a nation, as a world, as a population, we've started demanding things a lot quicker, and that's where the change has actually happened. So we have changed in a way. So we want things now, and we want profits now, and that's created speculative demand.
Yeah. No, I got it. We're going to continue with Sandy Jadeja in a moment, but first a reminder that on next week's program, we'll have the Director of Currency Research at FX360.com and GFT, Kathy Lean. Sandy, we've only got 5 minutes left in our interview, and we want to move into a part of our program we call a toolbox. And I think a great segue for that would be to mention the fact that, getting on about almost 2 years now, when oil was trading up at about $147 a barrel and an awful lot of analysts were talking about $200 a barrel and more, you went on CNBC on the actual day of the high and stated that oil would decline below $100. Why don't you talk to us about some of the tools you used to make that call?
Sure. Earlier on I said that I use Fibonacci as a tool. People often say to me that the markets are random, and I totally disagree with that statement. The markets, to me, have a random effect, but there are ways you can forecast using what I call the three-dimensional model. And that three-dimensional model is based on price, pattern, and time. And most people tend to just focus on price. They get carried away and tend to ignore the other two elements. And what happened with crude oil is it got to a point where, I remember in 2003, crude oil was trading at 37.5, and NYMEX crude was trading around the $37.5, $38 mark. And it actually broke out of a range, which had been stuck in for a while. So I, at that point, said we should start seeing higher prices in crude oil, probably the $50 mark, maybe even the $100 mark. These are psychological numbers, basically. You can take that for any market. I had no idea crude oil was going to go up to the $147 level. But along the way, when the market was making its move, and the one thing that everybody does this, they focus on a 5-minute chart or a 15-minute chart or an hourly chart, and even at best maybe a daily chart. And very few people look at weekly, monthly, and quarterly charts. And one thing that I'd learned from Robert Krause before he passed away was that multiple time frame analysis is key to long-term success. And what I looked at on the Dow Jones was that it was creating a Fibonacci and an Elliott wave 5-wave pattern, and it was reaching between 144 to 149, an area of resistance. And I found that when I zoomed it down to the daily chart, that it was showing a key reversal pattern. So for me, I thought actually this is now, I know everybody's going bullish here and we're talking about $200, maybe $250, but to me it looks like this is going to come off. And I said on that day, as of today, I'm quite heavily bearish on crude oil if it breaks below the $144 level. Because we cannot predict the markets. We can forecast. There's a difference there. So for me, the market had reached, in terms of price, pattern, and time, an area where it looked like it could reverse. And the market would then have to trigger that. And as I said, it broke below the 144. And then my view was that it would start breaking down in stages. And so obviously we were looking at the $100 mark. In actual fact, I said it would be looking at $87 at that time. We dropped below the $87 mark. But I use Fibonacci. I use a form. I don't use the exact Elliott count, but I use a form of Elliott wave. And I use trend analysis to determine what the longer-term trend is and trend reversals.
Okay. All right. Real quickly, we're coming down to our final seconds here. Would you like to give us your take on the markets for the rest of the year? And also, have you got any favorite books or influences you'd like to mention that you think traders would do well to be exposed to?
Yeah. The Dow Jones for me, 10,906 is an exact level that I'm looking at. We were at 10,850. My view is that we should get up to the 10,9 area. And then I think we're going to probably see like a 6 to maybe 10% decline going into October, November. I think the year is going to end probably lower than the 10,900 area. I'm looking at the 10.6 and the 10,250 area as key support levels. Now, of course, if the market continues higher and you'll see a continuation in the ADX indicator rising, then I'm wrong. Then the Dow could get beyond 11,000, could get up to 11,250. What I say to people is watch the market. If it starts breaking below support, we start selling. If it breaks above resistance, we keep buying. But in terms of price, pattern, and time, it looks like the Dow is getting to a point of exhaustion. Now, in terms of books, you absolutely have to read multiple times Reminiscences of a Stock Operator. I can't say anything above just read that book. I think I've read it probably no less than 30, 40 times. Jack Schwager's classical Market Wizards, New Market Wizards. I think these are absolutely key, essential books. The other element is you won't find everything in books. You have to get it through experience. These books won't tell you what to do, but they'll teach you a mindset. And if you want to learn how to improve your mindset, pick up as many books as you can in the sports psychology area, because a lot of research has been done there. And that's where your performance comes in. You learn about trading in the financial markets. You learn more by doing it. I don't believe in paper trading. I believe you should actually trade the markets physically. And as I said, in terms of performance psychology, you pick up the sports arena, and there's a lot of research in that area there. So, definitely the Reminiscences of the Market Wizards are an absolute must.
Yeah, that's interesting you'd mention that. I'm actually reading a new version of Reminiscences right now. Have you seen the new annotated edition by John Markman?
I have. I like it, but nothing beats the old classics. I just,
Okay. All right. Well,
books, and I think the old classics are fantastic.
For those who haven't seen it, I really like it because there's a lot of names and situations that Lefevre mentions that modern readers really don't know who these people are, and he breaks out who they were and what their background was. Listen, okay, we've got to conclude, but before we go, Sandy, is there anything else you'd care to mention?
I'd just say, it's a lot of people are worried about the future in the markets, as in the economy. Hey, you know what? We need volatility. So embrace the volatility. Gold's trading at $1,300 right now. Oil is stuck in that range between the $70 to $85 range. Look for simple things. You don't have to complicate trading. Look for simple things. Breaks above higher highs, breaks below lower lows. That's a classical way of trading. Don't be afraid to buy at higher prices. Don't be afraid to sell at low prices. This is the stuff that you'll learn in Reminiscences of a Stock Operator. I think that the markets are going to offer great and wonderful opportunities, although scary for some people in the next 2 years. I don't think we're going to see a market low until 2012. But again, as I said, there's some great opportunistic times ahead. Just embrace opportunity and, just trade with the markets.
Embrace the volatility. Today's guest has been Sandy Jadeja, and that wraps up today's MTA podcast. From SeattleTechnicalAdvisors.com, I'm Ed Carlson, together with our recording engineer Shane Squark in New York City. Say goodbye, Shane. Or
so
not.
long, everybody.
Let's keep our stops tight. Good day.